Okay. Let's address the elephant in the room.
The very shiny, very expensive elephant.
Exactly. It's January 25th, 2026. Gold is trading at nearly $5,000 an ounce. Silver just cracked 100.
Wild numbers.
So the question is gold actually worth that much? And I asked this as, a believer in gold. It feels like a metal from the gods.
It's a staggering number, for sure. But here's where it gets interesting. For centuries, we've built everything on the geological scarcity of gold. That's been the bedrock.
Right.
But what if that bedrock is, well, what if it's fundamentally flawed?
Yeah.
What if a new form of capital exists that isn't just scarce, but absolutely scarce?
Absolutely scarce. You're leading us toward Bitcoin, aren't you?
I am, but probably not in the way you're used to hearing about it.
Not for buying coffee.
Definitely not for buying coffee. We're talking about it as a thermodynamically superior form of capital.
Okay, for what purpose?
For issuing digital credit. And the secret to it all is this financial engineering concept called volatility stripping.
Volatility stripping. Sounds like something from a physics class.
Okay, before we dive into how that works, I just have to ask a quick favor from everyone listening.
Please do.
We are chasing a goal of 1,000 subscribers. Seriously, that number is what decides if this show stays alive or, well, vanishes into oblivion. So please, just take a second, hit subscribe on YouTube, Spotify, Fountain.fm, wherever you're listening right now.
And if you want to dig deeper into the mechanics we're about to talk about, check out the links in the description. We've put together a free Bitcoin course, really a selection of deep dives that'll give you a whole new perspective.
All right, the drum roll is officially complete. Let's get into the physics of capital. You said gold is flawed. Its scarcity isn't absolute. I'm guessing you mean because we can just dig more of it up?
Exactly. Gold has what we call elasticity. At $5,000 an ounce, mining is just ridiculously profitable.
Of course.
So companies dig deeper, they invent new tech, they extract gold from ore that was worthless before. The high price actually creates more supply, which dilutes everyone who already holds it. It's a negative feedback loop.
It is. Gold inflation is almost always like 1.5% to 2%. Every single year, no matter what.
So the more valuable it gets, the harder humans work to make it less valuable. Okay, contrast that with Bitcoin for us.
Bitcoin has a constant in its C++ code. It's literally called max money.
Max money.
And it creates a perfectly inelastic supply curve. If Bitcoin's price goes to $1 million tomorrow, the mining reward, the new supply, it doesn't change. Not one bit. The supply is completely sealed off from price.
That's a profound difference. But for me, the issue that always comes up is trust. I can see a gold bar, I can hold it, I know it's there.
But do you really? Auditing gold is a nightmare. I mean, you have to literally drill into the bars to make sure they're not just tungsten plated with gold.
Which has happened.
This happened a lot.
Yeah.
You have to trust the vault, the auditor, the paperwork. It's all double entry accounting, where you just hope the two books match. Bitcoin gives us triple entry accounting.
With the blockchain being that third shared entry.
Precisely. It's the shared, immutable truth. There's a command you can run on your own computer. Bitcoin Clyde gets outset info. Costs nothing. Takes a few minutes. And it mathematically verifies the entire global supply. It's the zero-cost audit.
So instead of trusting a guy with a drill, I trust math.
Yeah.
Got it. But we have to tackle the volatility. You called it volatility stripping. Bitcoin can swing 20% in a week.
Yeah.
How do you possibly build stable credit on that roller coaster?
This is the real aha moment. Think of an electrical engineering concept, the flyback converter.
Okay, a flyback converter. I'm with you.
In electronics, you take a high-voltage, fluctuating input, like the power from your wall, and you run it through a transformer.
And it gives you a stable, consistent voltage for your laptop.
Yes. You got it. Bitcoin is that high voltage. It's high-energy, volatile capital. The financial institutions, they're the transformer. They use instruments like a cash and carry trade. You hold the Bitcoin, but you sell a futures contract against it.
Ah, so you're splitting the asset. The futures contract captures all the risk and volatility for traders who want that. Right.
And what's left over at the other stream is just a stable dollar-denominated yield for the lender. You've stripped the volatility out.
You've stripped it out. Or look at what MicroStrategy does with its convertible debt. They absorb the volatility, so the bond market just gets a simple, stable product. They are refining market chaos into boring, safe credit.
That makes a surprising amount of sense. And it ties into that velocity mismatch idea from the research.
It does. Information moves at the speed of light, but value gold. Wire transfers moves at T+2 settlement speed. Days.
And that lag, that friction, creates what the source called slop.
Slop. Spam. Ads, clickbait. Because we can't send a fraction of a cent instantly, we monetize attention instead. Bitcoin aligns the speed of value with the speed of information.
So what is the final takeaway here? Are we actually watching the construction of a new financial architecture on, well, digital gold?
It really looks that way.
Yeah.
But this whole thing is a community effort, and it's happening right now in real time. So we want to know what you think. Are we being too optimistic here? Is $5,000 gold just the beginning of this digital transition? Let us know in the comments.
Yeah, critical thinking is everything. Don't just take our word for it.
Absolutely.